Howdy, Jacob here. Today we're looking at Oshkosh Corporation in the machinery industry, 7.1 billion market cap on 7.6 billion enterprise value. They provide purpose-built vehicles and equipment worldwide. Okay, I think I've seen them around in the trucking business, on travel and such. So 6.8 billion revenue to 9.7 billion in 2023. That's a little bit of growth there, not too bad. It looks like recently grew a lot. Not surprising at all, given that trucking and shipping was very large the last couple of years. But I'm actually surprised there hasn't been a decline in revenue, because I've been seeing a decline in revenue from some other shipping businesses I've looked at. Gross margin pretty consistent, not very high. Operating margin not too much lower, high single digits. That's pretty consistent with what I see in trucking businesses. Good increase in dividends, and most recent year, it's really nothing compared to their earnings per share. So payout ratio should be fine. Return on invested capital pretty solid, averaging maybe 8 to 12%, so not bad. A little bit of debt on that balance sheet, 125 million cash on hand with 175 million short-term debt, 600 million long-term debt. That 600 million long-term debt is pretty small in comparison to their 5-year average free cash flow. So less than 3 years. We're not concerned about that. Their use of cash is their dividend pays out. Their dividend of 1.7% is maybe a 30% payout. They use a little bit of money for share purchases, and then a heavy amount for acquisitions. They went into debt recently for an acquisition. We'll see whether that was a positive acquisition or not, because, from what we're seeing here, that there's not really a big increase in free cash flow. And I want people to buy companies or make acquisitions that make the company more efficient. You don't just want to make acquisitions to hit the top line and just hit that revenue growth. You care about cash flow. You care about earnings. You want it to hit the bottom line. And we'll see whether that's the case or not. But it's going to make our assumptions a little bit odd, because we don't know what those margins are going to be, the new margins, but we'll have to project with what we have. So when it comes to revenue growth, I think 5% seems pretty reasonable. Margins, 5. Okay. Let's do 5, 5.5. Let's do 5.5, 5. Share change, 1% would be about 70 million. Offset stock-based compensation about 100. Doesn't look like it. Let's say they just offset stock-based compensation. They're using about 10% of their free cash flow for that purpose. I think I'm comfortable there. PE, price free cash flow. The margins aren't very high. Not a lot of reinvestment. I think a 13. I think at the end of 7 years, you're not going to have the same growth as other businesses, and I don't think there's much going for them here. As for a dividend, 1.84 currently, and they are increasing it down here about 10%. I don't necessarily think I'd want them necessarily to do that, but they're already just buying back shares, paying a dividend. Let's increase that with their revenue growth. So payout stays roughly around 30%. We're saying the company's going to make acquisitions to get a 5% return a year in these type of margins. Otherwise, they're going to use 10% of their free cash flow for share changes, 30% to dividend, which leaves about 50+% to reinvest, make acquisitions, pay down debt. I think I'm pretty comfortable with those assumptions, and we're saying it needs to fall 41% before you get the return we're looking for here. So not an obviously amazing business. So to me, I want to get this at a pretty fair value, pretty cheap price, and I don't think it's there for me just yet. But I do hope you enjoy the video. Have a great rest of your day. Thank you.